Good morning and welcome back to SNN. Breaking story today on the hour. Goldman said earnings for the quarter jumped 51% to $2.1 billion, or on 5.48 per share, from a year ago when the bank was weighed down by loan loss provisions and surging expenses. Company-wide revenue rose 7% to $11.32 billion on growth from asset and wealth management and platform solutions divisions. Goldman CEO David Solomon has endured a tough year thanks to dormant capital markets and strategic missteps. But hope has been building that Goldman can turn a corner after pivoting away from Solomon's failed consumer banking efforts. The growth engine for the bank, according to Solomon, is now its asset and wealth management division, which is benefiting from the rise in private credit and other alternative assets. Asset and wealth management revenue jumped 23% from a year earlier to $4.39 billion, topping the street account estimate by nearly $550 million on higher revenue from equity and debt investments and rising management fees. Helped by rising markets in the fourth quarter, Goldman said it booked gains on public equities and markups in debt investments. Other Goldman divisions met or slightly missed expectations. For instance, in the company's trading division, stronger than expected results in equities mostly offset a miss in fixed income. Equities trading revenue jumped 26% to $2.61 billion, thanks to derivatives activity and financing fees, topping the $2.22 billion street account estimate. Fixed income posted $2.3 billion in revenue, a 24% decline from a year earlier on weakness in interest rate and currencies trading, and well below the $2.53 billion estimate. Investment banking fees fell 12% to $1.65 billion, matching the street account estimate as the industry's slump in completed acquisitions continued into late last year. Goldman's core activities of investment banking and trading didn't rebound strongly in the fourth quarter, but analysts will want to hear about the possibility of a recovery in 2024. Early signs are that corporations that have waited on the sidelines to acquire competitors or raise funds may finally be ready to act this year. Unlike more diversified rivals, Goldman gets most of its revenue from Wall Street. That can lead to outsized returns during boom times and underperformance when markets don't cooperate. That was reflected in the bank's return on tangible equity, a key metric tracked by investors and analysts, which was just 8.1% for 2023, far below its medium-term target of 15% to 17%. The bank said it cut headcount by 7% last year, or 3,200 positions from the end of 2022, mostly from a wave of layoffs at the start of 2023. Goldman and Morgan Stanley, which also reported fourth-quarter earnings on Tuesday, are the last of the largest U.S. banks to release results for the period. On Friday, J. Morgan Chase, Bank of America, Citigroup, and Wells Fargo each posted results that were marred by a litany of one-time items.
More top news on the hour. Burger King owner Restaurant Brands buys chain's largest U.S. franchisee. Restaurant Brands International is buying Carrols Restaurant Group, the largest Burger King franchisee in the U.S., for about $1 billion in cash. Restaurant Brands will pay $9.55 per share to acquire Carrols, which operates more than 1,000 Burger King restaurants and 60 Popeyes locations. Carrols stock closed at $8.42 on Friday, giving it a market value of $459 million. The company's shares jumped more than 12% in pre-market trading Tuesday. The deal is expected to be completed by the second quarter of 2024. The acquisition, announced Tuesday, is a shift in strategy for Burger King. Its restaurants have been almost entirely franchised for the last decade, and the company currently only has 75 corporate-owned locations. It comes more than a year after Restaurant Brands unveiled a $400 million plan to revive Burger King's U.S. business. Burger King sales had been lagging behind the competition, and Wendy's overtook it as the second-largest burger chain by U.S. sales. The comeback strategy focuses on investing in restaurant remodels and advertising to drive demand and boost franchisee profits. Restaurant Brands plans to remodel 600 of Carroll's Burger King locations rapidly over the next 5 years and then sell them back to franchisees, Tom Curtis, president of Burger King U.S. and Canada, said in a statement. The company will invest about $500 million, funded by Carroll's operating cash flow, to pay for the renovations. Earlier this month, Carroll's pre-announced its fourth quarter results, sharing that same-store sales for its Burger King locations rose 7.2%, while traffic increased 2.9%. The franchisee typically outperforms the rest of Burger King's U.S. system. This was your SNN News, live from Series Studios at K.L.P Entertainment. Good day, Atlanta.